A lot of parents, grandparents, and family members want to be able to help a child financially, but they have no idea which account makes the most sense for them. Choosing the wrong account could have unexpected tax consequences, give unrestricted access to funds for a child, or even create financial aid problems when it comes to applying for college. Welcome to Demystify, where we bring clarity to everyday financial decisions. Today, we're going to be talking about how parents, grandparents, and family members can save for a child's future, what the different type of accounts are that are out there, what are the pros and cons of those type of accounts, and which one makes the most sense given your goals. People want to help children financially, but oftentimes they default to what someone casually mentions to them. Really, what it comes down to are the goals for the funds, what liquidity restraints you're okay with having, whether or not you want it to be a completed gift, what you want those funds to be used for, and the tax consequences of those different types of accounts. Saving early matters far more than saving perfectly. So creating those systematic programs in place so that you at least are saving on a defined timeline really will help over the long term when you're dealing with investments. The account you choose today can dramatically affect the flexibility 18 years from now. Let's start with 529 plans. I would say these are probably the ones that are most familiar to people, as everyone's heard of a 529 plan, or at least most people have. These are investment accounts that are designed for educational expenses. The way that a 529 plan works is contributions are made with after-tax dollars. Over the years, those dollars grow, and as long as they are used for qualified educational expenses down the road, any growth, when distributed, is actually federally income tax-free. So what is a qualified education expense? This could be tuition, room and board, books, supplies, stuff of that nature. They actually expanded it recently to where it can be used for K through 12 expenses as well, for private tuition, for example. This is something they changed. They increased the limits and increased what it can be used for within the last year or so. Anyone that is looking to save for education specifically, now this doesn't just mean college, these can actually be used for trade schools as well. This type of account is specifically designed for education. So if the goal is to provide college education or tuition assistance in the future, the 529 is likely the best bet for them. It's important to note that each state has different rules from a tax benefit perspective when it comes to the 529 plans. So it's important to know how your state operates. Pennsylvania, for example, offers state tax deductions for any contributions that are made. So for example, you put $5,000 into a 529 plan. In Pennsylvania, you'll receive a $5,000 tax deduction at the state level for that contribution. The downside to the 529 plans are that they are specifically designed for education, and if they're not used for educational purposes, you're going to get taxed and penalized on the growth of those assets. So if you're saving for a child and they end up not going to school and they want to withdraw the funds for anything other than those education expenses, they're going to pay ordinary income tax plus a 10% penalty on that growth. They did actually make changes to the rules in Secure 2.0 Act, which came out in 2022. What this allowed for is up to $35,000 of a 529 plan, these unused funds, can be rolled into a Roth IRA. It is important to note that it follows the same contribution rules as the Roth IRA. What I mean by that is there are annual limits to Roth contributions. For example, in 2026, the contribution limit for a Roth IRA is $7,500. And in order to make a $7,500 contribution, you need to have at least $7,500 in income, and your income can't be over a certain threshold or you're not eligible to make those contributions. Those same rules apply when you're moving funds from a 529 plan to a Roth IRA. It is important to note that there is a $35,000 lifetime limit for a beneficiary. So if there are unused funds and you either funded the Roth IRA completely and there's still some left over, or you don't want to go that route, the other option you have outside of the penalty withdrawal is going to be renaming the beneficiary of that particular account. You will actually be able to change the beneficiary to someone else in your family. One important thing to note, specifically for grandparents looking to save, is that within the last couple years, they changed the rules. Meaning now, if a grandparent has a 529 plan for their grandchild, it does not negatively impact the grandchild for the purposes of financial aid, whereas before it did. 529 plans are a great tool if your primary goal is education funding, but what if you want to save for something other than education? A type of account that could be used for non-education funding is a Uniform Transfer to Minors Act account, an UTMA. What this account is a qualified, non-retirement investment vehicle that can be used to save for children. In order to open this account, the child needs to be under the age of 18 and it's funded with after-tax dollars. It's important to note, this is a completed gift. So if you're putting money into an UTMA, you lose control over those assets, whether you're a parent or grandparent. You cannot take those funds back out for your use. You can distribute as long as the funds are being used for the benefit of the beneficiary or the child in this scenario. Every state has their rules when it comes to the age of majority. In Pennsylvania, for example, the age of majority is considered 21 years old. What that means is once the child turns 21 years old in Pennsylvania, that UTMA account is now theirs and they can do and use it for whatever they please. So you're losing a little bit of control with the UTMA. It's also important to note that with the UTMA, this counts as an asset of the child. So when they are going to apply for college and they're going to apply for financial aid, this asset will negatively impact them from the financial aid standpoint. An UTMA does not provide the same tax-free growth that a 529 plan does. However, any income, whether that's dividends, capital gains, or interest that is generated with the UTMA account will flow through to the child's tax return. So typically, especially when you're dealing with young children, those children in very low tax brackets to the point where any income generated will be taxed at 0% or a low rate. So to summarize, the pros of the UTMA are that the income generated is not taxed at the parent's rate, it's taxed at the child's rate. The funds can be used for non-educational expenses. They can be used for anything. They could be used for educational expenses. They just don't have to. The drawbacks, it's going to count against the child for the purpose of financial aid. And as a parent, grandparent, or family member, you lose control. Once they turn 21, that account is theirs to do as they please. One reason many parents and grandparents do not go with the UTMA is because of the loss of control. For me personally, I actually decided not to open an UTMA up for my son because I wanted to control those assets. And who knows? Who knows what he will be like when he's 21, but if he's in a position where I don't feel like he should have access to those assets, I want to have the control there. So what is the alternative? You could always go with a regular investment account. No fancy UTMA, no fancy 529 plan. Just a regular investment account, which is in your name. That's what I am personally doing for my son. What are the benefits there? I retain control. I can put money in. I can take money out. If he's 21 and I don't think he should have those assets, I can dictate that and I can say, yep, not yet. As I see fit or as I want to give him those assets, I can gift him any amount. It's not an all or nothing. Let's say the account has $20,000. At any point in time, I could gift him $10,000 worth of stock. He can then sell that stock. It'll be taxed at whatever his rate is, and he can use it for whatever he would like. Also, it's not going to count as an asset of him. Now, it will count against him from the standpoint of a parental asset, but it's not going to have as much of an impact as if he were to own the account outright like an UTMA. So what are the downsides? Well, first of all, from a tax perspective, any income, capital gains, dividend, or interest that is generated on that investment account are flowing through to my tax return, which is likely going to be significantly higher than what my son's would be. In many cases, this can be used as a broader funding method where it's not just designated for college expenses and you retain control of the assets. These funds could be used for a house, to pay for a wedding, to buy a car, whatever you want to use them for, you can. I want to touch on a fourth type of account, which is very new and not a tremendous amount of information is out there, but that is the Trump accounts that I'm sure many of you have heard of. The way this account works is any contributions that are made up to $5,000 is currently the annual limit, are made with after-tax dollars. This is an account that is through the government, and once the child turns 18, they now have access to these funds. If you apply for this account for a child that was born 2025 through 2028, as it currently sits, they're actually going to fund it with $1,000 for you. This type of account, from a tax perspective, after-tax dollars go in, any growth is growing as taxable ordinary income. So let's say over the lifetime you put $50,000 in the account. When the child is now 18 years old, there's $100,000 in it. The $50,000 that you put in is going to be tax-free. The $50,000 in growth is taxable as ordinary income to the child. So from a tax perspective, Not the best benefits, but I just wanted to briefly touch on it because it is a type of account out there that is getting a lot of headlines and it is relatively new. Everything I just said, I'm sure is subject to change. They're not officially rolled out yet. We're filming this in May of 2026 and they're not actually available until July 4th of 2026. So it is subject to change, but I just did want to briefly touch on it. It is a type of account that is designed to really be used for anything. So it's not necessarily a dedicated funding source like a 529 plan would be. It could be used to start a business, to buy a house, for whatever expenses the child would need at that time. Whenever these new type of accounts emerge, it's really important to understand how they work, understand the tax consequences, and understand the use cases before you just jump right in because it could have adverse tax impacts. In summary, there are really 3 types of accounts, fourth being the Trump account, but 3 main type of accounts that you can contribute to. A 529 plan, which is primarily designed for education purposes. So if education is the goal, 529 plan is the way to go. The UTMA accounts. This is really if you want to gift assets out of your estate because it's considered a completed gift and want to fund non-education related expenses to give the child the flexibility. Remember, as the gifter of those funds, you lose control and the child does have access when they turn the age of majority in whichever state they reside in. Lastly, you have the regular investment account. Nothing super fancy here, but this affords the maximum amount of flexibility and control so that you're dictating what those assets go to and when they're distributed. You don't necessarily have to choose one. For me personally, I have a 529 plan and a regular investment account for my son. Really, it all comes down to picking the account that makes the most sense for your situation and your goals. Some of the mistakes to avoid are just choosing an account without really understanding how they work, considering the flexibility or distribution rules, or how it could impact a child from a financial aid standpoint. The best account is not necessarily the one with the flashiest tax benefit. It's the one that fits your goals and objectives the best. Thank you for watching today. I really appreciate it. If you could like, subscribe, and share the video, that would be greatly appreciated. Have a great day.